Welcome back. In this video, what we're going to talk about is why do we own stocks and bonds together in the same portfolio? And yet I thought in between taking these videos that I should probably share with all of you why it is that we're doing this series at all. You see, there's so many people that we talk to every day, and if I said, do you know how a stock works? People would say, yeah. Do you know how bonds work? They would say, yeah. Do you know what asset allocation is? They would say, yeah. Well, I recently, and this is after nearly 2 decades of being in this industry, I recently started asking clients something different. I said, if I just asked you what's a stock, would you feel comfortable explaining it to me? If I were to ask you what's asset allocation, would you be comfortable explaining it to me? And that's why we're taking it with a new level of seriousness to educate our clients in these videos so that you always feel like you could at least point somebody to a resource that could explain it, or that you yourself would become comfortable enough to explain it to somebody else. So let's talk about why we own stocks and bonds together. So when you own a portfolio, if you picture that pie chart, some of that pie chart is stocks, equities, and some of it's bonds. And you'll hear people say things like, oh, I have an 80-20 portfolio, or I have a 70-30 portfolio, or I have a 50-50 portfolio. And we're not talking about somebody's eyesight being poor when we're using those numbers. What we're talking about is the actual allocation, that's how much we're allocating to equities, that's stocks, that number's usually first, and bonds. How much is going to go to bonds or fixed income? That is everything from cash to CDs to bond type investments inside that portfolio. Now, the reason why we own both stocks and bonds in a portfolio, and in a later video I'll talk about building a diversified portfolio, but for now just stocks and bonds, is because they move at different times in different directions at different rates. So we might have a period of time where our 70% stocks in our portfolio does really, really well. Equities are performing at all-time highs, and now it's taking up 80% of our portfolio. Well, big problem. We now are taking more risk than we originally intended because we have more money in the more volatile equities in stocks than we have in bonds. So we have to rebalance that portfolio between stocks and bonds. And when we rebalance it, here's what I want you to think about. We're selling high and buying low, meaning the stocks outperform the bonds. We're going to be selling those stocks at a relative high to buy the relative low of the bonds. And so over time, stocks can go down. It goes the other way. Now stocks only make up 60% of our portfolio, and bonds now make up 40%. Now we're going to sell some of that fixed income portion of the bonds, and that's going to go into the stocks. And so we're effectively selling high and buying low. Now, everybody talks about the fact that what you should be doing is buy low, sell high. That's the secret of the stock market. Except that secret isn't easily obtained. And you guys can see that in our videos on the illusions of investing, that there's no academic evidence that anybody out there can actually predict when to buy and sell stocks. But what we can do is consistently move money between fixed income and stocks because of the way they move differently, so that we're able to sell high from the portion of our portfolio that's done really, really well and buy low to the portion of our portfolio that has not.